Hello, I'm Gene Tunny, host of the Economics Explored podcast. It's Friday, the 4th of February 2022. Earlier this week, we learned that the proposed single payer healthcare scheme in California, which would have been funded by a big hike in state taxes, will not proceed. It's been knocked back by the legislature. This is a proposal that I spoke about earlier this year with renowned US libertarian economist and tax policy expert Dr. Dan Mitchell. Dan and I chatted about this proposal as well as what's been prompting people and businesses to leave California. Dan argues that if this controversial proposal had gone ahead, then California would be in even more trouble economically than it is now. So please check out the clip. If you like the clip, then please consider listening to the full podcast episode. See the links in the show notes. Okay, thanks.
Now, having said that, let's move on to California, because when you talk about governments becoming like Greece, California could just be America's Greece, because what the governor there is talking about, Gavin Newsom, is a tax plan that would be enormous in terms of the relative. California already has a very big public sector. The state is basically run for the benefit of public employee unions, it seems. But what they're talking about here is a massive single-payer government healthcare system financed by a 2.3% gross receipts tax. And what's a gross receipts tax? I don't know if you have that term or that system in Australia, but basically it's just a tax on the revenue of businesses. So you could be a money-losing business, but if you bring in $10 million a year, and even if you've lost $1 million, the government's going to say, we get 2.3% of that $10 million. So it's sort of like an additional sales tax in addition to the sales tax that California ever has, but it's sort of just levied on any monies that come into the business. That's one tax. And by the way, that would be 3 times higher than any gross receipts tax anywhere in America. And by and large, right, left, center, public finance economists think that gross receipts taxes are not very good or efficient or sensible ways of taxing. But then you also have a payroll tax applying on any business with more than 50 employees. And so guess what? If you have 45 employees, are you going to expand? Probably not. But then here's the real kicker. Raising the state's income tax rate, which is already the highest in the country, 13.3%, raising it to a top rate of 18.05. Now, let's think for a second, Gene, why this doesn't make sense. Right next door to California is Nevada with 0 income tax. Just 2 states to the north, you have Washington State, 0 state income tax. Not to mention Texas, where a lot of high-tech California firms are already moving their operations. Texas, 0 state income tax. Florida, which is aggressively recruiting businesses and entrepreneurs from California, 0% state income tax. Tennessee, where Art Laffer, famous for the Laffer curve, he moved from California to Tennessee, 0% state income tax. So if California is already suffering an outmigration of productive people because of a 13.3% state income tax, imagine what it will be if this plan, which, and Democrats have a supermajority in the state legislature in California, so there's really no obstacle to them pushing this through. And you can save 18% of your income, of your proprietorship income, of your partnership income. There's such huge savings that will be available to entrepreneurs, investors, and business owners if they simply move across the border. So I think this is. I used to say California was committing slow motion economic suicide. This is an absolutely crazy plan in a federal system like the United States, where there's no restriction on moving across borders. It's not as if California can put up a Berlin Wall. And it's not like, the United States government has some very bad exit taxes that make it hard for Americans to move overseas, but there's nothing to stop an American from moving from California to Nevada or Texas. And so perversely, I almost hope this plan goes through, not because I harbor ill will toward the people of California, but I just think about how much fun I'll have writing about it and saying, look, I told you so, because it's really it's gonna accelerate that exodus of productive people out of California. And it's just baffling that the politicians in Sacramento, the state capital, again, the insight of public choice economics is politicians are short-sighted. Their time horizon is the next election. The productive people, the high-end taxpayers in California, are a small minority, and the politicians figure we'll get votes from the masses by targeting this small group of people. But guess what? Those geese with the golden eggs, they have wings and they can fly away. And if this happens, they will.
Yeah. Wow. I mean, yeah, it's extraordinary. I mean, it doesn't seem sensible to try and introduce a single payer healthcare system in a state. That's the sort of thing you'd want to do nationally. Otherwise, you might have people wanting to move there, and they may not necessarily be the most productive people. And so I can see how that's going to increase your costs. It seems. Seems.
And when you say that, Gene, that raises a point I should have mentioned. Vermont, a few years ago, considered a single payer plan, but they backed away for just the reasons you pointed out. The cost would have been enormous. California, a few years ago, considered it and backed away, but now they're back. And with Democrats having even more ironclad control, they think this time it might go through. Colorado had a referendum, I think it was probably 4 or 5 years ago, a referendum on a single payer system. And Colorado's a blue-leaning state now, and they rejected it, I think, by like an 80% margin. So maybe what will happen in California is the politicians will do it, but then there'll be some referendum where the people of the state save themselves from this initiative. But who knows? All I know is if I was an entrepreneur, an inventor, an innovator, a business owner in California, I would right now be looking at the real estate market in Texas because it's not a friendly place to try to create wealth, build jobs, and be in the productive sector of the economy.
Oh, absolutely. And there are so many people who are creators or in the creative economy and entrepreneurs who are moving to places like Texas and Florida. So you've got Tim Ferriss and Ryan Holiday in Texas, and you've got, I think, Dave Rubin's just moved to Florida. And I think Ben Shapiro might be there as well. So, lots of people have left California. Right.
Now, I should add one other thing. If you're one of these rich, high-tech people, and you actually don't have that high of an income, you're in California, you're in that industry because you're getting all these capital gains, but they're unrealized capital gains. So you have a stock portfolio that might be going up from $10,000 to $10 million and stuff like that. Well, for people like that, they can't be taxed until they actually sell their stock. So some people in the high-tech industry, will they be insulated from this kind of tax plan? Yes, they probably will be. But guess what? When it's time for them to finally cash out, are they going to stay in California when it's time to realize those capital gains? Almost certainly they'll be moving someplace else. So yes, some people in California will still stay there because it's a great state with a beautiful climate. It's like the climate on your east coast of Australia. There's a lot to be said for California's natural beauty, its climate, its recreational opportunities. It really is a spectacular state, but governed by some spectacularly misguided people. And I just think in the long run, that's creating Greek-like conditions for California's fiscal future.
So as economists, I mean, we could be grateful that you do have so many states with different political makeups in the US it gives us all of these natural experiments, and we can see the impact of different policy settings. So we'll definitely keep an eye on California. Just before we go, Dan, there were a couple of things. This gross receipt tax, that's not a GST or a value-added tax, is it? This is on. It's not as if they're going to be. They won't get back gross receipts tax they pay on goods and services that they buy for their business. Is that? Do you know how
Right.
it would work?
It's not a value-added tax or a GST. There's no credit invoice system. There's no subtraction method system. This is just if you take in $10 million or $100 million, whatever amount you take in as a business, you have to cough up 2.3% of that to the politicians. So it's an especially bad tax if you're in a low margin industry. Are there some really profitable companies out there, like some of the high tech firms? Yes, but if you're, say, a grocery store or a place like that, I mean, a gross receipts tax is a really, really big burden that you literally have no choice but to pass that on to consumers, and not to mention, workers, because you'll probably be cutting back on your operations. And again, as I said earlier in our discussion, Gene, this is something that if you went to the left-wing public finance experts who believe in higher taxes and bigger governments, they'll be shaking their heads saying, no, don't do it with a gross receipts tax. That's very distortionary, doesn't make sense, doesn't operate in any sort of horizontal equity fashion that at least almost all economists purport to believe in.
Yeah, absolutely. And we had a whole bunch of those in Australia, sales taxes and wholesale sales taxes, and they were all abolished and replaced with a national goods and services tax. I know you're not a great fan of those value-added taxes, but maybe we could chat about that in a future episode. But it was probably better than the view was that was a better thing to have than all of these what you'd call gross receipt taxes. So yeah, that's what we did in the 90s. What about this exit? You talked about exit taxes from the US. What did you mean by that?
If you're a rich person in the United States and you want to move someplace else, the United States has a regime where, in effect, we shake you down at the border. The simplest way to think about it is, and it goes beyond this, but this is really at its heart what it's all about. If you have unrealized capital gains, even if you don't sell your assets as you move out of the country, the IRS says we're going to treat you as if you have sold those assets, and we want our slice of all those unrealized capital gains. Now, is it as nauseating and noxious and disgusting as the old exit tax regimes that you had in totalitarian systems like the Soviet Union? No, of course not. I don't want to imply that the U.S. is anywhere near that bad, but is it bad policy? Yes, I think it's very bad policy. I believe that emigration is a human right, and you should be able to move if you want to have the benefits of a different country's tax system.